The US has slapped a 25% tariff on steel and aluminium imports from countries worldwide. In response, Canada and the European Union are hitting back with their own tariffs on American goods, worth billions, raising concerns about a global trade war. President Trump has also warned that he'll impose a massive 200% tariff on alcohol from the European Union unless they drop their hefty 50% tariff on whiskey. On top of that, he's already put a 25% tariff on some imports from Mexico and Canada, though with a few exceptions, and added a 20% tax on Chinese goods. Tariffs are basically taxes on goods that come into a country from abroad. When businesses import these foreign products, they have to pay the tax to the government. Most of the time, tariffs are a percentage of the item's value. For example, if there's a 20% tariff on Chinese goods, something that costs $10 would have an extra $2 added to its price. Companies might decide to cover the cost themselves or pass it on to customers by raising prices. The US has traditionally had lower tariffs compared to other countries, but economists are worried that Trump's new taxes and the additional tariffs he's considering starting on April 2nd could cause prices to jump sharply for consumers in the US and worldwide. Trump sees tariffs as a key part of his economic strategy. He believes they'll help boost US manufacturing, protect American jobs, and bring in more tax revenue, all while strengthening the domestic economy. Another big goal is to fix America's trade imbalance, closing the gap between how much the US imports from and exports to other countries. However, he hasn't ruled out the possibility that his trade policies could trigger a recession. In fact, US stock markets took a hit just before the new metal tariffs kicked in. Despite this, US Commerce Secretary Howard Lutnick later insisted that the tariffs were worth it, even if they caused an economic slowdown. At first, Trump's tariffs mainly targeted goods from China, Mexico, and Canada, countries that made up over 40% of US imports in 2024. But beyond trade, he's also accused these nations of not doing enough to stop the flow of migrants and illegal drugs, like fentanyl, into the US. The 25% tariffs on all US imports of steel and aluminium officially went into effect on March 12th. The US is the world's biggest buyer of steel, with Canada, Brazil, and Mexico as its top suppliers. Canada is also the largest supplier of aluminium, making up nearly 60% of what the US imports. When Trump first announced these tariffs, he insisted there would be no exceptions. But on March 11th, he threatened to double the tariffs on Canadian metals. This was in response to Canada raising electricity costs for customers in 3 northern US states, a move they made to push back against other US tariffs. However, just hours before the new rate was set to kick in, Trump backed down after Canada agreed to drop the extra energy charges. This isn't the first time Trump has imposed these tariffs. Back in 2018, during his first term, he set steel tariffs at 25% and aluminium at 10%. He later made deals with countries like Australia, Canada, and Mexico to grant them exemptions. Even with those exceptions, the US International Trade Commission reported that the tariff still drove up the average price of steel and aluminium by 2.4% and 1.6% respectively. Other countries wasted no time in responding to Trump's steel tariffs. Just hours after they took effect, Canada and the European Union hit back with their own retaliatory measures. Canada imposed a 25% tariff on an additional $29.8 billion Canadian dollars, $20 billion, $16 billion worth of US goods starting March 13th. This includes $12.6 billion Canadian dollars worth of steel products, as well as sports equipment, computers, and cast iron items. Incoming Canadian Prime Minister Mark Carney has signaled he's open to trade talks with Trump, but only if there's respect for sovereignty. The European Union is targeting US goods worth €26 billion, £22 billion, with new tariffs that begin on April 1st and will be fully in place by April 13th. The list includes everything from steel and aluminum products, like pipes and window frames, to consumer goods like boats, bourbon, and motorbikes. European Commission President Ursula von der Leyen criticized Trump's move, saying tariffs are bad for business and worse for consumers. Trump, however, isn't backing down. On Truth Social, he warned that unless the EU removes its 50% tax on US whiskey, immediately, he'll slap a massive 200% tariff on all wines, champagnes, and alcoholic products coming from EU nations. He even claimed this would be a boost for American wine and champagne businesses. Meanwhile, the UK, which exports hundreds of millions of pounds worth of steel to the US each year, is taking a more cautious approach. Prime Minister Sir Keir Starmer told Parliament that the UK will handle the situation pragmatically, but is keeping all options on the table. China, on the other hand, has reacted strongly. Its foreign ministry said it would take all necessary measures to defend its rights and interests, arguing that Trump's tariffs violate World Trade Organization (WTO) rules. Trump had already introduced 25% tariffs on other goods from Canada and Mexico, though these were delayed for a month for negotiations before going into effect on March 4th. In addition, Canadian energy imports now face a 10% tariff. To ease concerns in the auto industry, Trump later announced a temporary tariff exemption for North American-made cars that meet the rules of the US-Mexico-Canada Agreement, USMCA. This deal, negotiated during his first term, set specific requirements for how much of a vehicle must be made within the three countries to qualify for duty-free trade. Car manufacturing relies heavily on cross-border supply chains. Auto parts often move back and forth between the US, Mexico, and Canada multiple times before a car is fully assembled. Following the exemption, shares in major US car makers rose. Trump then extended the exemption on March 6th to cover other goods traded under US-Mexico-Canada Agreement, USMCA, including televisions, air conditioners, avocados, and beef. He also reduced tariffs on potash, a key ingredient in fertilizer used by American farmers, from 25% to 10%. Right now, the UK isn't facing any specific US tariffs beyond the steel ones. Britain exports a lot of goods to America, including pharmaceuticals, cars, and scientific instruments, and the UK government is actively negotiating a broader trade deal with the US to remove tariffs altogether. As for Europe, Trump has hinted at more tariffs coming. During a February 26th cabinet meeting, he said he would announce specific sanctions on EU goods very soon, but so far nothing has been officially introduced. One major factor in all of this is the US trade deficit with the EU, which hit $213 billion in 2024. Trump has repeatedly called this an atrocity, so there's a strong chance he'll push for more tariffs to try to close that gap. Trump's tariffs have set off a chain reaction, with Canada, the European Union, and China firing back, raising fears of an escalating global trade war. Prices are rising, industries are feeling the heat, and the stock market is on edge. Pertinently, the ongoing tariff war is creating significant disruptions in the global economy, affecting trade, investment, inflation, and overall economic growth. With major economies like the United States and China at the center of this conflict, the consequences are being felt across multiple sectors worldwide. Economic growth is already slowing, and a prolonged tariff war threatens to make the situation worse. According to recent estimates, global GDP could decline by 0.6% in 2025 if trade restrictions remain in place. For the US, the impact could be even more severe, with a long-term reduction in economic output by 0.3 to 0.4%. The uncertainty surrounding trade policies has also led to financial market volatility, causing the US dollar to lose all its gains since November 2024. Meanwhile, safe haven assets like gold have surged, with prices reaching a historic high of $3,000 per ounce in March 2025. One of the most immediate effects of tariffs is inflation. As import costs rise, businesses pass these expenses on to consumers, increasing overall prices. In the US, inflation could rise by 1.0 to 1.2% due to tariffs, reducing consumer purchasing power and slowing down economic momentum. Countries that rely on imports for essential goods, including emerging markets, will also experience price hikes, adding to financial stress for businesses and households. Trade volumes have also been affected. The level of global real exports is expected to be 2.4% lower than baseline projections by 2025. The sharpest declines are projected for China and North America, as supply chains become disrupted and companies shift production to avoid tariffs. The US itself is expected to see a 4.5% drop in real imports by 2025, while China's real imports could fall by 3.2% as its export-driven economy struggles with higher costs. Financial markets are reacting strongly to these trade tensions. Foreign portfolio outflows have placed significant pressure on equity markets, leading to currency depreciation in emerging economies. In India, for example, foreign capital outflows in February weakened the rupee, prompting the Reserve Bank of India to inject 5.5 trillion rupees in liquidity into the banking system through various measures, including open market operations and forex swaps. As a result of liquidity concerns, Indian banks have increasingly turned to certificates of deposit, with issuances reaching a record high of 10.58 trillion rupees. By March 2025, a 34% increase from the previous year. Investment decisions are also being affected, particularly in China, where both foreign and domestic investors are adopting a cautious approach due to financial stress and declining equity prices. The trade war has led to a sharp reduction in foreign direct investment in emerging markets that are targeted by US import tariffs, further slowing economic activity. The timing of this trade war is particularly concerning. It is happening at a time when global economic stimulus is fading, oil prices are elevated, and political risks are rising. Growth is already slowing, and with global GDP projected to be 1.4% lower by 2026, if the tariff war escalates further, the risk of a broader economic downturn is increasing. If the situation continues, countries will be forced to turn inward, prioritizing domestic industries over international trade, which could result in long-term inefficiencies and weaker economic performance worldwide. Despite these challenges, certain policy measures could help mitigate the impact. Central banks, including the RBI, have been proactive in managing liquidity conditions, while some governments are exploring trade agreements to diversify economic partnerships. However, unless a resolution is reached between the world's largest economies, the negative effects of the tariff war will continue to weigh on global markets, trade, and investment in the years ahead.